Awesome. Good morning, everyone, and welcome to another series of Conversations to Innovate, brought to you proudly by the Innovator Trust. For those joining us for the first time, a very warm welcome to you, and we're absolutely honored to have you here this morning with us. And also a big thank you for making the time actually today to join us for this very insightful webinar with the lovely Serena Davis. I will get to tell you a little bit more about her very soon. And for those that are returning and are not a newcomer with Conversations to Innovate, a warm welcome to you too. And thank you for joining us again. Just a little bit about the Innovator Trust. We were established back in the year 2014 with the mandate of supporting the growth of SMEs, specifically within the ICT sector, and ensuring that all the SMEs that go through our program are upskilled, competent, and sustainable. We do this through our various programs, mainly the enterprise development programs, supplier development programs, and the youth entrepreneurship program. In all that we do, we are absolutely firm in our ethos, which is to innovate, cultivate, and mentor SMEs. Today, I'm joined by Ms. Serena Davis, who is our facilitator for the day. She is the co-founder of Hippo Seeds, which is an advisory firm and has a career spanning over 20 years. While she has worked in different types of companies such as venture capital, telecoms, incubators, accelerators, and startups, the common denominator has been product innovation and finding the perfect product match. That brings us to our topic for today, which is investor readiness and what to expect. For those of you who might have joined us last year, you'll remember we did do investor readiness under the theme Beyond the Pitch Deck. And I'd love to hear from you guys if any of you actually took those learnings and implemented or even pitched to an investor, and what was the outcome of that. So please do connect with us in the chat box, even on social media. We are at Innovative Trust across all social media platforms. And we'd love to hear from you. What were your learnings last year? What are you looking forward to today? And what's been your biggest takeouts during the entire session of this webinar? However, what you can expect in today's session is, one, how do VCs actually work? What is their investment thesis? What is their lifetime window? What is the difference between angel investors and VCs? We can also look forward to data rooms and diving into that. Looking at the difference between a data room and a Google Drive. What goes into a data room and why? What is a data room? Serena will be telling you guys all of those answers because I don't have them. She'll also be sharing some sample term sheets with us. So please do stay online, stay tuned for that. That's some very handy resources that she'll be circulating, as well as major terms of a sheet, specifically liquidation preference, as well as dilution calculations. So there's quite a handful that we'll be looking at into today's session, so please do stay online. With regards to questions and answers, we will be doing questions after each section. So I urge you, I encourage you, please pop your questions into the Q&A box down below. Chat section, you can pop in all your suggestions, your key takeouts, but any question that you do have, please do pop that into the Q&A so that we do not miss it. We will be addressing those after each section, as previously mentioned. However, if you don't get a chance to put your question in the Q&A box after the section that you want to ask about, you're still more than welcome to do so at the end of the webinar. Serena will be presenting between 10 and 12. Thereafter, we'll be doing any other remaining questions between 12 o'clock and 1 p.m. So we definitely have the time for them today. We also do have a prize for the guest that stays on for the entire duration of the webinar and also actually completes our survey. Once we are done, please do not close your Zoom window. There is a survey prompt that will pop up on your screen once we've ended the webinar. Please do complete the survey, as we would love to hear from you. What do you want to learn more about? What would you like us to cover? What was the key takeaway from today? So please don't just run away from us. We would still love to hear from you. Ms. Serena, a very warm welcome to you as well. We're very happy and honored to be joined by you this morning. I heard you mention earlier that you're joining from the United States.
Yes, that's true. I unexpectedly came here, so it's 3 a.m. for me. That's why it's so dark.
Oh, wow. 3 a.m. yet you're here facilitating the session for us. Oh, wow. Thank you so much. A very big thank you to you. I'd also actually love to hear from our attendees online. Tell us where you're joining from, your company name, where you're based, and where do you guys operate. We'd really like to get to know you a little bit more. But for now, I will hand over to you, Serena, just to take us through our session for today. I know I'm very excited, so I'm sure our attendees are as well. I will be back after the first section just to take us through any questions that have been popped into our Q&A. So I guess please do enjoy and please do engage. Serena, over to you.
So I would just like to, thank Innovator Trust for putting this together and for everybody who's given us the trust to show up. There's so many people doing webinars, but we're going to be handing out resources as well, very practical resources that you can act on. So this is not just theory as well. Mandis already went through today's program. So I won't get into that much more. The resource we'll be giving is a data room, an actual checklist that you can use for yourself. I'm giving the one that I use when I do due diligence and when I help startups to go through the due diligence process. So I'll be handing that out. You'll have that sample data room that's basically an enactment of the checklist. I've put in also sort of commonly what's act for startups. A lot of startups don't have advisory boards or run board meetings, know how to. So I've sort of put in a sample board meeting agenda so that you can get an idea of what they look like. A sample deal memo. We'll get into what a deal memo is when we get into how VCs work. A data room providers so that when we talk about data rooms, you can have an initial list rather than just go to Google. A list of VCs. So all of this is open source information. That's all in the Excel sheet. So real quick, I'm the co-founder of Hippo Seeds. So we say that we're backing founders who have the courage to solve difficult problems because we're in a moment in the world where there's a lot going on and we have to worry a little bit more than about just making the next Facebook. I work together with Zad Mehdawi. We come from the incubators, telecoms, but also civil society. We believe very much from a very young age, both of us we're volunteering and working, at looking at our society as a whole and how we live together and how we work together. And so that's why we include it here. Now, where do I come from? I want to give a little bit of background from me. I recently went to an artist talk here where I am by an indigenous artist, Two Trees. And I love the way she started the talk. So she had the bio that was given as an introduction. And she said, the bio introduction is a statement of what I've done, but not who I am. And I like that so very much. So I put together this small presentation to give you a little bit more about who I am, because I think in venture capital, we get really caught up in the fact that it's money, but money without a purpose or without a focus or, the people whose hands it in really matters. And so I wanted to give you a chance to get to know me a little bit. So, but don't worry, I'm not going to take too long. I am starting off from the beginning when I say where did I come from? I say that we all come from the same place, which is our mama's belly, right? That's an actual picture of me in my mama's belly. That belly happened to be located in Bonn, Germany. Now, one of the reasons that I created this "Where am I from" is because I've moved around a lot. So it was hard to, the most difficult question for me to have to answer most of the time is like, where do you come from? I always have to take a really big breath when it comes to that. So I was born in Bonn, Germany, and then shortly thereafter, we moved to Kansas City, Kansas. Then we moved to Kansas City, Missouri. Then we moved back to Germany, Heidelberg. Then we moved to Washington State, then to Virginia, then to Washington, D.C. Then we moved back to Munich, Germany. Then we moved to Texas, and here in South Korea is where I finished my high school. So all of that moving I had done by the time that I was 17. Then I graduated high school, went back to Texas, started in mechanical engineering, finished my degree in economics, but not before studying in the UK in Newcastle. So studying economics in the US was very sort of pure capitalism, only about money. In the UK, it was more Keynesian. So it was, what's the government's role in society? And then I studied economics in Germany, where it was seated in the philosophy department, because it was that economics is a tool to achieve the philosophy that you want for society and how we live together and how we get along. So that's what shaped a lot of my early thinking, and also around product development. Like, what are we doing? So after that, then I went back to Texas, where I started in venture capital, young 24-year-old, and the venture capital industry was just starting. It was back when venture capitalists had to be founders. They had to be successfully exited founders and not just finance people. So that was really exciting, because they talked about, products and customer service and technology and just a lot of things like that. And then I moved to the Netherlands, where I worked in 3 large telcos, had 3 exits. Then I moved to Greece for a short time. And then I went to Kenya, where we raised 60 million for a telco there, started by a woman named Jerry Wananchi. And now I'm basically back in Greece, where I work from as my home base, and I go around moving as projects are needed. So kind of a summary of where I've been and what I've done. And, the highlights: I've been in 3 venture capital companies ranging from 15 to 250, and held C-level suite in 4 different companies. So it's really about products. If you get the branding, sales, the product delivery, and customer service together, this is the really important focus. So let's dive into it. Okay. How do VCs work? Now, the reason that I wanted to introduce you to this is because when you take an investment from a venture capitalist, I say this, and I always get a laugh when I'm in front of an audience. That's the only thing about Zoom that I miss out on is the audience's reaction. But is that it's easier to get out of a marriage legally than it is to get out of a relationship with a venture capitalist, and even with an angel investor. It's easier to get out of a marriage. So what I wanted to do was to explain to you, how do we work? How do VCs work? So you can also get an understanding of their thinking, why they think that way, what's reasonable, what's fair, what's not fair, so that you can also, start to forge a good relationship, and build an honest one. Venture capitalists, often people who hold money, they think it means power, but the truth is that we need you. We are sitting on a pile of cash, but without your ideas, it's pointless, right? So you do something we can't do, and it should be a partnership. So there's different stages to investments. Okay, there's pre-seed, seed, seed plus, and Series A. The differences between them basically have to do with traction. So the monthly revenue in pre-seed and seed and seed plus are very different. The size of the rounds, that's the term that we use to say the investment size, and the funding source. These are the main differences between them. Traction for pre-seed is going to be, it can be pre-product, depending on the appetite of the investors. So a lot of your angels, they love, you get people who have disposable capital, and they have an appetite for pre-seed, depending. Others, want to get in a little bit later. So pre-product or pre-launch up to paying customers, that's considered pre-seed. Seed is once you have proof of product market fit. Now, how do you prove that? Well, that usually has to do with how many sales you're doing, how many customers you're able to get. Seed plus, you start scaling. Excuse me. So you've proven the product market fit, and now you're going to roll it out to more people. And in Series A, you're starting to do market expansion. Your monthly revenue in pre-seed will be about, up to 25K. Let's say that's the kind of range per month. Seed is 25 to 150K. And then it just kind of goes from there. And that's monthly revenue, right? So the size of the investment, we consider pre-seed, up to 750K. This includes angel investment as well. They kind of the same. So you'll get angel investors in pre-seed, maybe in seed. I love investment on the African continent. It's so much different than anywhere else. You have really the most amazing, robust angel networks. It's great. And so you can get angel investors into the seed round, 500 to 2 million angel investors who invest next to traditional venture capitalists, which is great because it gives VC competition as well. So as the market matures, that's going to be good news. And then the source, we say friends and families, probably the first the first people invest with you is often time, or when you go to your, if you're married or your partner and you say, okay, I want to do this entrepreneurship thing. We're going to be living off of your income. That's a type of investment, right? And so you get angel and then pre-seed VC. And then into seed plus you get seed funds. There, it's really, you need some professional investors because they know how to really form the deals in a way that makes sense. So first thing, venture capitalists have a fund thesis. So you need to know who are you going to approach during an investment. And so you can get some vague titles like health tech or ed tech or something like this. But usually a fund will have a fund thesis. Now, they're not always the easiest to find, but they'll be somewhere either on Crunchbase, or if you Google them, there should be some kind of statements from the founders. So I'm going to go through a couple of examples. So Hippo Seeds, our fund thesis is that we're a 5 million pre-seed impact fund backing purpose-driven founders in Greece. Sorry, I can't invest in Africa, although I do angel investment there. Leveraging our startup ecosystem network, where we built accelerators and we've raised funding over 80 million and helped over a dozen pre-seed startups get their first customers. Now let's tear this apart a little bit, right? So what we're saying right away is that we're in Greece, right? So this tells you where, geographically we invest. So that probably puts most of you out. I'm assuming most of you are coming from the African continent. Now, I wanted to say, let me digress a little bit. I recommend that everybody, I see that we've got 50 people, 49 people showing up to this. Oh no, 72. Sorry, those are the chat comments. 72 people. Put your LinkedIn in. This is a great networking opportunity. If you showed up to this, this means a lot of you are in the same stage, and you probably can give each other, advice on what to do. And have somebody, go through this journey with you. So put your LinkedIn in the chat so everybody can find you. Mine is just at LinkedIn. If you look up Serena R. Davis, you'll find me. I'll be happy to connect with you. So here you see that we like pre-seed startups, right? We are interested in purpose-driven founders. So I want to know somebody who's thinking about the community. This can happen a lot of different ways. Doesn't have to be the product itself. We have some experience. That's good for you to know, right? We've built accelerators. So why does that matter to you as a founder? Well, it means that we know how to scale a company. We know how to take you when you're kind of wobbly in the beginning. If you're going to have to pivot or something like that, we can probably walk you through that and join you in on that. We're not going to be nervous because you have a product that you haven't quite figured out product market match. And so we love early stage, and we're there with you. Another one, Union Ventures. They say that they invest in large networks of engaged users, differentiated through user experience and defensible through network effects. Now, this sounds all very vague, right? What does exactly this mean? What they're saying is they're not going to invest until you have a large user base. Now, they're not talking about revenue. They're talking about just a lot of engaged users, because they believe that if they have engaged users, it's going to be hard for people to leave your product. So that kind of makes sense, right? And so that's when they engage in wanting to invest with you. So you've already had to have quite a bit of success of some form before they find you interesting. So Hustle Fund, another example, we invest in early stage tech companies with low overhead and founders who hustle, generally in North America and Southeast Asia. So if we pull this fund thesis apart, early stage, really good. That's nice. Low overhead. Basically, it means that you haven't scaled yet. They're looking at a team. They want small teams, 2 or 3 people. They probably don't do hardware because that has a lot of cash. And they're looking for founders who are basically, answering their emails at 2:00 in the morning. Probably don't care about work-life balance. And that's their definition. That's their fund thesis. So you need to know that it needs to match. Sequoia Capital is one of the absolute most successful investment companies. Here I found a quote from one of the investors there that says, we engaged in that companies with an engaged community have the strongest moat. Now, a moat just means, if you think of a castle and a moat around the castle, how people can enter into your area. So they basically kind of prefer something that looks a bit like a monopoly, or they don't prefer markets that have a lot of players in it. So that's the fund thesis. We'll ask questions. We'll get to questions. So the business of venture capital. The lifetime of the fund is typically 10 years. You'll hear things like a rolling fund or things like that, but let's say right now industry standard is 10 years. This 10 years is divided into 2 windows. It's an investment window of 5 years. That means that after that 5 years, they can no longer do investments. So if you find a venture capital fund and they're in year 6 and they're saying, they're having meetings with you, it's because they want you to educate them. VCs are very good at wanting to be educated on different things. So, be very careful about that. And then the second is 5 years is the exit window. So what does that mean to you? Why should you care about this? Imagine that you're running a fund for 10 years. If you're in year 1 and you're a startup and you get invested in, that means that you have 9 more years together to create an exit for them. And an exit just means that they, have their cash event that brings the returns that they want. If you're getting an investment in year 5, that means you only have 5 years. So they would expect you to be more mature, looking at an exit scenario much sooner. So this puts a different pressure on the VC and how they're going to look at you and what their priorities are with you. So it is absolutely important to understand this about them. And then the last item of management fees of 2%. Why should you care about their management fees? Well, I'll explain it to you. Okay, so I've taken Hippo Seeds as an example. Let's look at the fund math. For us, we have a 5 million total that we can invest. We have the average deals. So when you go to the website of a venture capitalist, they'll say our average ticket size is something. For us, it's about 300,000. So that's puts us, we say we want to do about 10 deals for the VC, usually in press releases for a fund. They'll tell you this kind of information. And then if you take out the management fee, which is 2%, right? Which is on a 5 million fund, that's 100,000 per annum. That's it. That covers my founders and my salary, all our travel costs, all the lawyers' fees for closing, every single thing that we're going to do per annum, and pay taxes. So it's not a lot of money. Micro VCs, we do this, it's not for the salary. We absolutely love what we're doing. And it also gets into, when we look at the amount per annum, it gets into why VCs ask you to pay for the lawyers. And I'll talk about that a little bit later when we talk in the term sheets, but you can understand with the 100,000, if I'm going to give you 300,000, you have more cash than I do in order to be able to pay certain expenses. And I can actually I can more easily, economically deploy more capital to you to cover any expenses that we bear together than I can taking it from my management fee. And so that's to help you understand a bit the thinking of what they're doing. The other thing is that, and very important, is that 15%. So if this is by law, okay, it can vary, but for fiduciary, what they call fiduciary responsibility, the maximum you can invest is 15% of the total amount. And that's so that, the whole idea behind venture capital is that for an investor, it diversifies risk. If you're putting too much into one deal, then you're essentially not diversifying risk. So that will tell you how much. If you're going to go raise 2 million and you come to us, we could never do the full 2 million. What we could do is together to say, okay, we absolutely love this. We would invest 750,000. We would be what's called the anchor investor, and we're willing to go to other people with you to raise the remaining amount. But what you need to understand is, can they write a ticket for the full amount for you? And that's important then, because then you'll understand, okay, they're going to have to bring other people together. And it has a big impact on timing of closing your funding. So if someone has a 5 million fund and they say, no, we can invest the 3 million, that's not true. What they're telling you is that they believe that they have the network that they can pull this together. So this is just the rest of us. Now, Agri VC has 3 separate companies. I'm just telling this so you can get an idea a bit about how they function, because when you understand their governance, you'll understand, how they function. So Hippo Seeds, we're the general partner. Essentially that's one company, and it's a management company. We're essentially a management company that gets hired by limited partners, what's called limited partners, essentially investors. And we get into an agreement together with them as investors. They have an agreement among each other, because you'll have, up to 100 investors that create the 5 million. They have a shareholders agreement. And in that shareholders agreement, they hire us as the general partner, basically to run the business for them. And then the third company is the actual where the cash is held. I have no ability to disperse that cash. There is a custodian bank that has a set of rules based on that shareholders agreement of the limited partners. And based on that, when we sign, we follow the governance and we sign the agreements. That's when capital is released by the custodian bank. And then those get basically invested in the investment. So that's how we work. And that's oftentimes why things can take time, but they should give you insight into this. Okay. So the questions you should ask, and you should ask many, but this is the basic questions you should ask when you're speaking to a VC is, what year are you on in the fund? So you can understand their pressures about exit windows, right? How much deployable capital do you have? So also when you get around year 5, it means they've been spending money. How much more money do they have? I had approached a friend who was at the end of her first funds, and she only had 200,000 left in deployable capital. And she was like, look, I had kind of an angel investment that I thought she'd be interested in. So I knew she had 200,000 left of deployable capital, which was plenty for what the little startup I was working with was interested in. And that's the language, deployable capital. What's your internal process and average timelines? You want to get into an agreement with them about timelines, because VCs can be the biggest timelines. They don't have a sense of urgency like you do. Absolutely not. And we'll get into the term sheet, how you can kind of tie them down. But from the beginning, you should try to get into an understanding of timelines and hold them responsible, because they'll take 6 months, 7 months. For you, every single week is like a year. And for them, they work on quarterly, yearly. Their time windows are very, very different. And then what is the standard equity position that you want? So if somebody says, you get this a lot in venture studios, where they'll say like Y Combinator is one of them. I'll give you 100,000 investment for a standard 8%. And so if they're for us, for pre-seed, because of future dilution, we'll get into what dilution is. we need a higher standard equity. We need a sort of standard equity position of around 10 to 15%. And so that's good for somebody to know. So you can understand, oh no, I only want to give away 5%. Okay. But then also understand that you have to be at a much more mature phase in order to be able to ask that kind of thing. Okay. So we're at the end of section 1. I know I'm probably speaking a little bit fast, but we have to get through. Just want to make sure that we can get through it. Mandisa, this would be a good time to have our first set of questions.
Okay, we don't have any in the Q&A box at the moment, so maybe we can go on to section 2, and then we can just combine any questions that come up.
Okay, so I really want to encourage you to ask questions, also LinkedIn. And Mandisa, here's a good chance. So during this seminar, I will make available to you a sample data room that I use with all my startups that you can download. If you can put that in the chat, in the chat box.
Let me do that now. Okay, I'll share that. Yeah, here it is. I'm going to copy this and share it into the chat box with everybody. If you can have a look at this at some point of the webinar and just download the documents that you might need, they're extremely helpful. That would be great. Okay, done.
Okay, thank you. So data rooms. What I've shared with you right now looks like this. I think I've changed the name to Master Data Room. And if you click on the arrow that's next to it, there's download. And it will download this entire folder. What you'll notice is that within each of these subfolders, business, financials, etc., is an additional checklist because I created it on my desktop in order to upload all of the folder. It needed something inside the folder. It's just a technical thing. But this is what I've shared with you. Actually, there's more now at this point. I'll leave this open for you, but only during the seminar. So please download it if you're interested. This will save you a lot of work. The master checklist we'll get into. But so what is a data room? It's basically this. We've all used some kind of folder system. The difference, though, is with a professional data room is that it keeps track of things. So this is, that's in my data room from a very long time ago when we were approaching investors. And we could give permissions to every single person, how long they had access, and have an overview. So here I sent one to Rema. He's got a 55 million fund of funds. And I can see, you see to the right, I can see that he's visited my pitch deck, because these seats have pitch decks as well. The first time for 1:22. Then it must have been good enough to stick in his mind because he came back and he spent 8 minutes on it. Now, the average time that's spent on a pitch deck virtually is 3 minutes, 3.5 minutes. So what I see from this, what I like about this digital data room is it will show where they're visiting. So I know that he spent the most time on the strategy document, and it tells me the thinking of the person. Now, when you have this, when you send out a pitch deck and you can have this oversight on what people are looking at, what they've downloaded, of course, you have control over who downloads what. I could get insight. When we had the next conversation, I knew immediately he was interested in the fund financials more than even the thesis or anything like this. So somebody, if they're spending time on the slide, it's either that they absolutely love it. Usually that's the case, because if they're confused by something, they just skip over it because these people don't have time. So that's usually a sign of this is they're interesting, and it can help you lead your next email. It can help you lead the conversation, and it gives you insight. These are the advantages. The other thing in a digital data room is that you can have all your signature documents. So if someone sees you at a competition, or you're networking, or you've been to their office, their attention spans are very slow. So you want to have all of this together so that when they're ready to sign, you have the documents and they're there, and you're like, here you go. I can collect digital signatures. Go to the data room. Here it is. Because time is really the biggest thing that having all this preparation saves. And with startups, you don't have time. Time is just a killer for you. So I'm going to go through, before we get into a bit more of the data room content itself, I want to just spend a little bit right now and talk about the 3 favorite slides. Okay. So you know how to do pitch decks. That's an expertise somewhere else. There's hours and hours of information on this, but I want to kind of go through a couple of slides and why these are better than kind of the industry standard that gets overlooked. Here, I'll tell you how my eyes see this. Right away, I know they're raising 2 million. Great. Usually with startups, what they do is for the use of funds, they do on the left-hand side, they do this. They show this percentage sort of pie chart of where it's spent. Okay, that's useful. But what I like about this and what VCs want to know is, what does the 2 million get me? What are you planning to achieve with that? And so this is why the right-hand side is good. And this slide is just, they really done well with this slide. It tells me, okay, they're going to grow to 100 paying mid-market. Their goal is to achieve 1 million in annual recurring revenue, and they're going to hire more marketing and engineering. Okay, so now I know what the 2 million gets me as far as milestone and business goals, rather than sort of just this pie chart of use of funds. So I wanted to share that with you because it's going to be a question that comes out, but this kind of thing gets a VC excited because they're saying, okay, where are we going together on this journey with this investment money that's going to be handed over? So you're also very, again, I'm talking so fast because I know how much more I have to share with you. Looking at my time, you may think it's 2 hours, but it's there's so much to share in this 2 hours. So the competition overview, you've done competitive analysis. The thing that I'm going to get into that often gets overlooked, is here what I like with the competition is that look at how he's put in, how much the other companies have raised. Now, why does that matter? Well, if somebody has, for example, 12 million and you're raising 100, and somebody else is 150K, who do you think has more resources to get into a marketing battle, or who has an ability to sort of execute? Who's going to be spending time on another raise? So this is sort of the thing that gets overlooked. When I understanding your competition is at this moment in VC, one of the most important things, because I want to understand, do you know the world that you're operating? Do you know who's your competition? And you'll save me time because I'll end up doing this homework. I absolutely go into Crunchbase and I see how much financing they have, who is the financer. So I get an idea of also what's the risks. Who are we looking at going into battle with? And so this is a Kenyan company, Mazi Mobility, Jesse Forrester, one of the most amazing first-time entrepreneurs that I've ever met. He's even up on what regulations, and he's also lobbying to have things change. He does the e-scooter business. But that was the big thing that impressed me on this. So keep that in mind when you're doing the competition overview. So here's another thing that may seem, kind of banal, which is an org chart. What's great with this org chart is you see that it's kind of color coordinated. So when you're going to hire, right? So you'll say, I want to hire 10 new employees. But what's nice here is it talks about when they're going to be hired in, and they use color on that, meaning, are you going to hire everybody within the first day once you get the money? Even with the 2 million that was in the previous slide, are you going to go to a next round? Do you have a vision of the organization as it expands? This will help me get you an idea of how much you've already scaled in your mind. So if you're deploying capital, if your sales are going slower than you think or something like this, are you able to sort of ratchet scaling up and scaling down based on whether or not your revenue is coming in the way you thought? So that's why I like this org chart. Okay, so I'm going to take a quick drink of water because we're going to get into this slide. Looks small, but it's the biggest slide in the whole presentation.
Serena, while you're having some water, I just want to assure you that you don't need to rush. We
Okay.
are here till 1 p.m. Yes. So yeah, take your time.
Okay. So the checklist that you have this basically an Excel sheet that's in that data room. It's divided into pre-term sheet and post-term sheet. So you do your pitch. The investor says, "Hey, I'm interested," and so there's two moments that you share the information. So pre-term sheet is something a little bit less. It's things that you can find publicly. It's things that you're not worried about sharing. And then post-term sheet, they have a legal right to know more and have more information about you. So basically, you're going to see the folders that were in the original data room that you saw. In the business, you have a long form pitch deck. So that's going to be 25 to 30 pages. It's the one that has base everything, right? The short form pitch deck, they probably already have it at this point. You can stick it in here as well. One pagers are very industry standard now. You can get templates for that on Canva. And then those are pre-term sheet, right? So they're going to want to take a look at these. You can put them in the data room. The board pack, here's the post-term sheet. A lot of startups forget to have board meetings. A board pack basically is what is all the information that I'm going to send to my board so that they can, I get a board pack on the boards that I sit on ahead of time. I read through all the information so that when we have the board meeting, I'm prepared. Now, don't make it so big. I don't want to need more than 1 or 2 hours to prepare for a board meeting, a quarterly board meeting. Why is it important to have it now? You don't have to have it now, but what you're doing in this journey together with your venture capitalists and what you're doing right now in your first raise, basically, is showing them that, hey, I know how to run a business. And if you, even with your co-founders, you should have milestones and targets every quarter. So it's very impressive if you are already running your company as if you have investment, because essentially you do. You're the investor. It's your time. How are you running this? How are you going to formalize? So I really suggest that you do this already, that you have quarterly meetings already, that you hold yourself accountable and the team accountable, and also then to give answers. Okay, we expected X, Y, Z. We didn't accomplish it. Why? What's our plan? So that's what goes in the business folder. In the financials folder, of course, you have the financial model. Here, you have to decide based on how much you trust the person. You never want to give away the cookie recipe. Never, ever, ever. The financial model, you can decide pre-term sheet to give just the big charts, right? The P&L, the revenues, those things. At some point, they'll want to get into a deeper financial model. So that goes in the financials. Cash flow is separate than financial model. These are things you can look up online. These could be a master class. But the cash flow tells me what's your runway. That's the vocabulary that you'll hear a lot. When I give you the money based on the business plan that you're selling me in this pitch, when we sign this relationship, how long would that cash last? Will it last 6 months, a year, 2 years? Could it get you to cash even? Where is it going to take you? And a lot of times cash flow includes a revenue line. So what I'll do when I get a cash flow Excel sheet from somebody is I'll look at the runway based on their assumptions about revenue, and then I'll take out all the revenue. We had this with COVID, right? And just see, okay, how does that change? So then I'll look at, based on the cash flow, again, is how much is new customers, how much is based on the customers, the revenue that's being generated now. And so that's the different risk that we look at. And if you do those exercises ahead of time, you'll be ready for their questions. You'll be able to see what we as VC see. So the use of funds is also to have it separate. Now, you could say I can put it all in one Excel sheet. That's true. But depending on the size of the venture capitalist, they will have analysts and they will have different specialists. So having it easy for them to find by having it as a separate item in the folder will make it easier for them. Even if you just taking, in your financial model where you have cash flow and use of funds, and then you're just creating a separate spreadsheet where that's standalone. Your management accounts, this is now very private, so please share it, only after you've signed a term sheet. Excuse me. The bank balance, again, it's something that's definitely after term sheet. Why do we want to know this? Of course, because we want to understand your cash flow. We want to understand from the management accounts, have you signed a big loan? Are we just giving you money to pay off a loan? Things like this. Have you received external financing? Have you won some grants? Do you have some angel money? Things like this. Fundraising folder, your existing cap table. I have a quick example for you of what a cap table is. And again, in that list, that link that Mandisa put up, please download it. It has a sample cap table. It's a starting point for you. You can go online. There's softwares as a service that do cap tables, and they do them well. You can do it by Excel in the beginning. All software as a service costs money. So, I know with startups, that's a problem. Then if you have your grant funding, that goes as well in your fundraising, folder. And the cap table basically is who owns what, but it has to do with dilution scenarios. So the cap table is going to become a very, very important document for you over time. For the legal folder, obviously to show your incorporation documents, right? That's understandable. Your articles of association, what you've agreed to, how to work together. Post-term sheet, the shareholders agreement that you guys are going to sign together. Any insurance policies. So for example, I worked at an aviation company. We had a very long list of insurance policies because it's dangerous. Whatever for your industry is going to be important to have, you should have in there. Your share options, your employee share options. It's considered very important. And I suggest it anyway to have employee share options. It keeps people motivated. You can recruit very senior people. I would not, for my whole career, I would not join a company unless I had employee share options that have been through several exits already. And then you can put in your NDAs that are signed. That's just to show, basically we look at that just to see that you have some governance, that you're paying attention to what you're paying attention. But insurance policies, you're going to hear something called a key man policy. I don't think startups should have it, but imagine I invest in you. Maybe you're a solo founder and I invest in you $400,000 and something tragic happens, knock on wood. Sometimes investors will ask for a key man life insurance policy as a way to recover some of the funds. If you have a co-founder, I really recommend that the two of you consider getting life insurance policies post-investment, right? You don't have money now to do it, but post-investment that you can get an agreement. That way, if something happens to your co-founder, while you're recovering from the tragic loss of this amazing friend of yours, you don't also go through the huge financial, burden of losing the company as well. So that's something to consider. So intellectual property. I actually went through a situation where a U.S. investor came to a Dutch company. They had all this amazing branding material called Goldmine, which was a terrible name anyway. It was very American, did not translate well to the European market. But they had not checked on trademarks in Europe. So they spent all this money on creating these brands, and they didn't have the trademark. And they ended up having to spend all this money to rebrand. So this happens often. You get started as a startup, you don't have the cash to pay for all of this. And then, an investor will buy into the brand, they like the logo, and it turns out you don't have the legal right to own it. So I would be transparent with the VC and say, look, some of our use of funds is going to be around the sort of IP protection. The most important thing is be transparent. Okay. You're going to get caught at lying. Now, there's a difference between being aspirational, of course, and saying, no, we know how to enter markets. Our customers love us, and of course, as a VC, I'm buying into your enthusiasm for your own product. But if you lie, you're going to get caught. And all of this due diligence process is about trust building. And trust building is two ways, right? It's not just that a VC should trust you. You need to also look at the behavior of the VC and make sure you can trust them. Because again, it's a marriage. I mean, it's easier to get out of a marriage. Patent report, don't worry about that too much unless you believe someone can patent what you're doing, and block you maybe from your work. But if you have a patent, the patent reports should be post-term sheet. Register your registered designs, copyrights, things like this. When I write here technology, again, never, ever, ever give away your cookie recipe. But you will give sort of the high level, diagrams of what it is that things are doing. You can say that here's where the magic happens. You can do demos that show it. You don't have to give away exactly the cookie recipe. So then in the team folder, your key player documents. So putting your CVs there. Founders agreement. This is often overlooked. So I've done angel investing where the whole thing is fallen apart because the founders disagree. So usually you start something together, you're super enthusiastic, you're headed down the road, and then all of a sudden you begin to disagree. The biggest reason for disagreement that I have found is, how are we going to finance this? Many founders have different runways. So each one of you may have a different savings account. One of you may say, hey, I can work on this for the next year. Somebody else says, no, if we don't get money in the next 3 months, I have to get out. So this founder agreement covers then the compensation and who owns what. Are you going to take a loan? Will it be against which assets? What other things with founders agreements? Product development roadmaps. I have seen founders, fall apart because of this. So a founder agreement covers that. And I want to know that the two of you get along. When I sit in a meeting with founders, you will usually have one founder who speaks, the most, and he's the champion or she's the champion for the company. But if this one founder talks over all the other founders and doesn't let people speak or thinks they know best, I take that as a red flag, because you're investing in a team and it needs to be a team. So this, please get a founder's agreement. Okay, contracts of your employees. That's post-term sheet, but basically I want to check that what you put in the financial model has been secured, that you're not, saying that you pay employees $2,000 a month, $2,000 a month, and you're paying them $1,500 a month, or vice versa. And for the hiring, so in the use of funds, you say you're going to bring on 5-6 people. If you want to be impressive to an investor, you will go to like Glassdoor or something like this and have, if I give you the money today, what are you going to do tomorrow? If you have the job descriptions ready, if you have a plan of how you're going to recruit them ready, I'm impressed, because time is money. So if you don't have those things together, you're going to lose days, hours, whatever, getting all that information ready. And so this just means you're already there. And that's impressive. That's the founders agreement, and your hiring documents are really things that often are the most overlooked. So if you have those, it's really impressive. I see a couple of questions, and just to give me a break, Mandisa, do you wanna look at the
Yeah.
question?
Yeah, let's definitely do that. Let's definitely do that. Thank you so much, Serena, for sharing all of this with us. I just want to reiterate the importance of that Google Drive link that you've shared with us. And for all our attendees, you're going to find all these templates there and all these sample sheets, or most of them, rather. Okay, we're going to dive into our questions. Please feel free to continue popping this into the Q&A box, and we will be answering them throughout the duration of the webinar. We have a question from Muziki, and she wants to know if VCs, angels, or impact investors coming into Africa consider market size and revenue that might not hold the same ticket size as in the US or Europe.
So definitely. What I love about the angel networks in Africa, first, you have more than we have in Europe. And because the angel investors are local, they understand very, very intuitively what the potential of the market is. There are also VCs, more and more VCs that are African headed and African run. So they understand the market. I know, for example, like Ghana and Rwanda, I think are super exciting right now. It always has to do with, what investment size. You're not going to ask for 20 million up front. I am working with a company, in Greece, and I said, look, they recently had an offer for a 5 million investment, but I said, at 5 million investment, your exit is going to have to be that much bigger. So you could come with us. We can build it together. And my requirement for an exit will be smaller and it'll be less pressure on you. So I think it's about getting the right partner as well, who can say that, okay, what we're interested in is the final returns and not like necessarily, conquering the whole world. So, yes, the simple answer is yes.
Okay. And also finding the right partner for your business. Speaking of partners, what are the other ways that a venture capitalist can possibly invest into an organization other than giving you funds, to grow your operations or business? Are there any other ways?
Right. So I love this question because I feel like Keepo Seeds has such an advantage over everybody else. But because my business partner and I are entrepreneurs and not finance people, one of the decisions that we use to make is, can we actually help raise the valuation in the first 12 months because of our sales network, because we've gone in and we say, we're engineers. So if something is, it's like building a Lego house. People have been like, oh, we don't have this thing over there. To me, that's, oh, great. We're going to build that together. And we've agreed this value. And if we build it, that means together we've raised the valuation, together. So especially in early stage, it'd be great to get what's called smart money. And that's what you're referring to, Mandisa. You asked the question so that I could look like a superstar for how I answer it. But absolutely, there's much more than cash that an early stage VC can give.
Okay, awesome. Tiki also wants to know, what reporting can startups keep leading up to raising funds that can help make them more presentable?
So this is one of the things, your board meeting. What goes in the board meeting? It talks about things like, what is your sales target? What are your hiring target? What's your product roadmap? When you have those quarterly meetings and you're meeting targets, then you're showing that, hey, I understand how long things take and I can project manage towards that. So it's not only just the list. I have to do 20 things. It's, do I know how to manage the resources that I have, which a startup is very small usually? And can I predict how I can achieve certain milestones based on that? And so that's a big part of recording that really helps to impress.
Okay, gotcha. Tabi Singh wants to know, can you walk us through the typical recourse or next steps if a portfolio company does not meet performance milestones or even faces potential failures?
I will do that in the anti-dilution clauses that's later in the presentation. So yes, I'll do that. At the end, let's make sure that I've answered the question. Let's circle back to the person who asked it. to make sure that I understand what they're saying. But we'll talk about when the capital runs out. This is covered by what's called anti-dilution clauses.
Okay, so we'll answer, we'll answer your question towards the end. I have just noted that one. Another question is, what is the difference? If you could just summarize it for us, Serena, what is the key difference between angel investors and venture capitalists?
Okay. So I love angel investors. Some VCs for pre-seed see it as a competition. I like it. I think, if I have a strong brand, HippoSeeds has a strong brand, and we say, hey, we're doing this, angel investors will see that as a stamp, right? Also vice versa. I love Dazzle in Johannesburg. It's female run, female investment, angel. There's also Rising Tides in Nigeria that's female focused. But they also are, I like them. We work well together. With Rising Tides, I haven't done anything with Dazzle yet. So the main difference is the informality. You will get more and less sophisticated angels. Sometimes you get angel investors on a call. Usually you'll want an angel network. The nice thing is that you'll have a lead that so they look a little bit like a venture capitalist. With angel investors, it depends on the sophistication, right? You can spend much time with an angel investor. Their ticket size is usually smaller, right? It's going to be 5, 10, 15,000. Do you want to spend 6 months on 15,000? You have to be really careful around this. So this is where a data room helps. Angel investors, again, they vary in sophistication. Tom Davies is probably one of the most famous angel investors in Africa. I don't know, it's been 200, 500 investments. He would definitely be a super sophisticated angel investor. And then you have others who are just, they have some cash and they want to invest, but they haven't really done it, and they can become a bit, not burdensome, but they can ask a lot of questions and spend a lot of time. Angel investors they're not tied to this 10-year thing that VC has. So that's the advantage. Angel investors can also provide networking, just like a VC can. They do it a little bit differently. As a VC, I can walk into a room, it's very formal. As an angel investor, you have to be careful with the company that you're at if you help to open doors that you're not in a conflict of interest. So angel VC and VC works very similar. VC is more formal. And angel has more, they can have more patience. They can wait a little bit longer. That's the advantage of angel. The advantage of venture capital is that you're dealing with, professionals. I have to be careful with that because angel networks are also very professional, I have to say. Yeah, I don't think I really answered that question well, to be honest. They work very, very similar. On the African continent, they really work pretty similar, but I'd say the biggest difference is about the formality of it. So which one you feel more comfortable with.
Okay, what about the lifetime window then with angel investors? I know you mentioned that it's less than 10 years you find typically with VCs. Is it much less? Is it 5 years, 1 year? It doesn't apply.
It's very individual, right? Somebody will say, okay, I'm just going to give it and I don't care. And their window's 20 years. Other will say, I have to put my kid through college in 3 years. I want to see the money back. So it's not as formal. And so in your discussions with them, also then your post-investment relationship looks very differently. VCs are very formal. Let's meet quarterly. You can get in a situation with angel investors if you're not careful. They're just constantly bombarding you with questions and constantly bombarding you. How are we doing? Are we, when am I getting my money back? So that part of the relationship you really need to be careful with. And so sort of formal angel networks, they provide a bit more formality. If you have a problem with one of their angel investors, you can usually go to them. But if you get a standalone angel investor of 50,000 and it's just just a person, and they really start to, try to interfere or things like this, you don't really have a lot of there's not a lot that you can do. You just have to manage that relationship. And if you have 10 angel investors, that's a lot of relationships to manage.
Okay. Then a peer wants to know, how do we determine how much equity we should offer a VC on their investment?
This, let's go through cap tables. I'll answer that when we get into cap tables. So let's keep that question in mind, and I'll get to that question later in the discussion.
Okay, cool. Up here, we've noted your question, and we'll revisit that one. Another question from Anonymous: does it cost to approach a VC to build your customer network? And they've got non-financial brackets.
Let's see if I understand the question well. It absolutely doesn't cost to approach a VC. Don't ever pay somebody to do that. You can just email them online. Now, of course, somebody who has a relationship with them or who is fundraising on your behalf, they may ask for a finder's fee. But just for a straight up intro, I don't know. For building customer base, it was the second half of the question.
Yeah.
I don't know somebody who's going to do work for you for free, but the VC, I haven't ever heard of a VC who then has a side hustle of sales and marketing. So Hippo Seeds, we're an advisory company. I will charge for services, but that's separate. That's not my function as a VC. I don't know if, can you check back with them to see if I've answered their question?
Okay. Yeah, I think that does kind of cover it, For Anonymous who has asked this question, you are welcome to post a follow-up question if you're still needing a little bit more clarity around this. I think Mohammed is a little bit stressed about a comment that you made in the beginning, that it's much easier to get out of a marriage than it is to get out of VC. And he wants to know, what are the key issues that make up the statement when you spoke about the fact that it's easier to get out of marriage than a VC?
So you will have a shareholders agreement. If you disagree, so let's take a scenario where both parties are being reasonable. The VC, has this 10-year life. They're getting to their 10th year. You're growing the way that you want to, and they want to drive an exit. And so it's going to it can create conflict then, right? Your shareholders agreement agrees to all the governance structures of how you do things. What are you going to do? How do you get rid of them? You have to buy them out. It's a cash transaction of how do you get rid of them? There's no legal way to get them out. When you have co-founders, you can have someone exit. Again, they're going to want to be compensated for their shares as well. But it's not an agreement to enter into lightly. You do lose freedom, and that's reasonable, right? Somebody's giving you their money. Nobody's giving that away for free. It's not charity work. If you want, no responsibilities money, there's grants out there for sure. I'm not sure it's very unusual if someone would give you their hard-earned money and then just say, hey, I don't care, do what you want. So even if you just took money from your neighbor, I don't think that, they're going to let you go without you compensating them. So, legally, that's just the way it is. It's true.
Yeah. And at the end of the day, both you and the VC are in business, and you're here to see a return on investment. So you want to see something come back to you at the end of the day. Okay. We're going to get into some agreements and questions around the NDAs. I'm going to take us back to the top. Tabi Singh has asked, is it advisable for early stage startups to rely on NDAs or collaboration agreements generated through ChatGPT or readily available Google templates, or should we consider specialized legal advice right off the bat? I'm trying to remain lean, but want to know when to invest in legal resources.
This is a great question. NDAs, ChatGPT is pretty good. A lot of it has to do with prompt engineering, this new term that we have. So as you know, ChatGPT basically is just a really, really quick way to data mine all the data that's out there. When you do your prompt engineering, basically you should say, write me an NDA based on South African law, or based on Ghanaian law, or based on Kenyan law. And if there's enough data out there on the internet, it will be able to find it. NDAs are pretty standard across the way. I recently was offered, one that was so complex. I couldn't believe it. It even had to do with, I couldn't believe how complicated it was. Depending on what you're doing, if you're really coming up with, I don't know, the latest gadget that's going to do space exploration, I think your NDA can remain pretty simple. The time to spend money is when you get to the shareholder agreement level, when you're starting to engage really with an investor who's serious. Then it's important. But I think NDAs are pretty good. They're pretty standard. Collaboration agreements, what you're going to compensate people with for their time. I think that's what we mean by collaboration agreements. Try to use prompt engineering that also includes the country. If you get a result that you're not satisfied with, then I think you have to follow your intuition. But again, it's a lot about relationship building, right? And building trust between people. If your instinct tells you this person isn't trustworthy, if they're showing up all the time to meeting late, if they don't deliver what they say, then didn't continue with them. Don't try to force a relationship because they're really good at the blah blah.
Don't try to force it. Don't try to force it. Awesome.
Should I keep going? Do we have more questions or?
Yeah. Let's do maybe two more, and then we can move on to the next session because we will get back to the others. I did have another question on agreements. Lee wants to know, how effectively does the founder agreement hold up in the event of an investor takeover of your business in the future?
So the founders agreement will serve as a foundational agreement between the shareholders agreement that gets signed. So anytime you get a new investor and you sign a new shareholders agreement, it always supersedes previous agreements. It will say that. Now, I, as a VC, whatever you've agreed to in the sense of, are you willing to take on debt? What's the product roadmap? What are the roles and responsibilities? That's those things in the founders agreement. Those should be easily translatable into the shareholders agreement, and you can negotiate that as you're going along with the venture capitalist. There's no reason that they wouldn't use it. Now, it worries me when you say, when the person who questioned asked, when venture capitalists take over, you should not let them take over. If you're, with small amounts of money in early stage, don't give away majority share. So somebody had asked this, but to answer it, shortly, usually first round, never more than 20%. Okay. You want to maintain, me as a venture capitalist, I want you to be happy. I want us to make the pie bigger. I always say, I'd rather have 1% of Facebook than have 95% of the company I have. I love my company, but Facebook is just worth more. Let's just be honest. So, when it comes to percentages, I think it's more important to build something bigger. So 20% though, I want you to be happy. You should be motivated. If I've taken 90% of your company just because I can figure out how to negotiate that, how motivated are you going to be to stay and to work hard? That just, well done for the ego who negotiated that, but that's just bad business in the long term. So, yeah.
Okay. Got you. There is also a question on data room before we move on. Mom wants to know, how will the data room structure of the VCGP differ from the startup data room structure?
So when you engage and you get to the point of due diligence, you could ask them for their checklist. If you've done all this work and you hand it to them, they, they should be thrilled to death. They'll have their separate checklist and they'll, look next to yours. This checklist is in the Excel sheet, so you can send it to them. They should be thrilled. Sometimes you'll get into, but not at early stage. I mean, customer acquisition costs. If you look up due diligence, you can get into, when we raised 60 million in Kenya, you can imagine that they wanted to know everything, shoe sizes. I mean, it was incredible, but at 60 million, that makes sense. You have to also decide, hey, how much time am I going to spend for somebody who invests 100,000 while you're busy trying to make sales and run your company and things like this? If you do the majority of this checklist, it's really enough. It's absolutely enough. So customer acquisition costs, the financial modeling, they're going to want to know you understand it. If there's any actuals that create your forecast, that really helps. But if the list gets much longer, you have to ask yourself too, is it worth the amount of money? Because your time is so valuable.
Got you. So really gauge the effort that you're putting in to the ask, gauge at what stage your business is in, and what you're hoping to achieve with this request.
Exactly.
Okay. Serena, I will let you move on to all the other questions I have. I do about 3 other questions. They've all been noted and we will get to them. But I'll hand over to you, Serena, to move on to the next session for now.
Okay. So the next folder is, you can see by the white space what else is coming up. This is the longest slide of the whole presentation. So in the product folder, some kind of product demo or something that gives them an ability to get a feeling for what it is you're selling. Technology deck, again, no cookie recipe, never give away the cookie recipe, but it'll be a high level, boxes. I have this box and this. A lot of times it's, if you have software as a service, of course, it's sitting on either Amazon or, Microsoft servers or things like these, that kind of technology deck. And then the product roadmap, where you want to get. Now, be careful. Product roadmap is part of your cookie recipe. So you could say, we're doing release 4 or release 5 with these major features. If one of these features is really groundbreaking, then I would be careful how you describe it. Okay. And basically do it absolutely post term sheet, or even post once the investment comes, where you say, look, I can prove that, this thing works. The product roadmap, we'll get into it in detail at that time. And you gauge again, VCs also show you every relationship, every human you engage with, of course, shows behavior that tells you whether or not you can trust them. In the commercial folder, your customers post term sheet. So again, you have to decide how much do you want to share for the amount. For me, let's have a discussion about what's reasonable. If you come to me and you say, I have 5 large customers that give me a revenue that's covering my basic costs, I would like to see at least the signature line of that as part of my due diligence. So pre-term sheet and post-term sheet. When a term sheet is signed, we'll get into this again a little bit later, but once a term sheet is signed, what I legally, we agree to valuation and things like this. What I do then at post-term sheet, or what VC does then at post-term sheet, is just to go into that next step to really see, okay, am I finding anything that would change my perception or change what you and I have agreed to the valuation on this? So I'm trying to be diplomatic, but basically, if we can catch you in a lie, or if we can look at something and say, if you say your customer acquisition cost is $2 and it takes 3 months to get a customer, but it turns out that it's really $4 and it takes 6 months, that fundamentally changes the financials, and it fundamentally changes then what your valuation is. So customers, again, if you say you have 5 signed customers that are going to bring in this revenue, and it turns out that you have 4 customers that are signed and 1 that you just think is going to sign, this will change what we agree to. Don't give out the customer names pre-term sheet. Post-term sheet, it's reasonable to ask for it. You decide if you want to, but I'm going to want to know, again, if you have software as a service and you have 600, customers in your database, what I will do is I will get a specialist to come in and do a data dump just to prove that there are 600 customers, and that it's not 200 or 400 or something like this. There's been quite a number of recent scandals coming out where the customer numbers were, grossly exaggerated. And that's, again, you can be aspirational about in the next year, we will get this number of customers. That's not lying. That's aspirational. And you and I can debate whether or not that's possible based on the financials, et cetera. But if you say you have a certain number of customers and then I run a data dump and I really do due diligence because I have very clever technical guys and you're lying to me, the deal is over. Now, if I do a data dump and I find out that, okay, you have a couple of, 3 or 4 or 5, repeat customers or duplicates, I'm going to take that down to sort of a bit of an error. It's not going to make me doubt you completely, but if you have duplicates, I am going to wonder, hey, how are you running your database? Maybe you need help with that. Your sales pipeline. So if you have these projections, and we talk to your sales on, again, you've handed over a sales contract and you're just waiting for it to be signed, it holds a different value. And you have to decide then really based on trust, whether or not you're going to, how much you're going to share. Letters of intent work the same way. I just worked with a startup that said they had 6 letters of intent. But when I opened the letters of intent, some of the forms have been pre-filled, except in the signature area, they hadn't even identified who in that company was going to sign. So I realized these letters of intent were very, very aspirational. And so the value of them dropped. Invoices, again, post-term sheet. If I can get from the management accounts, from your bank accounts, that the revenues are actually coming in. If you're sending out invoices for revenue, that's another way that I conduct due diligence to show that your historical revenue actually came from the customers that you're saying. That's how we're checking on due diligence, because you could have revenue, a one-off revenue that's very different from having a customer who's going to be recurring revenue for you. Your marketing materials, pre-term sheet, if you have a brand Bible, brand guidelines, that's also, it shows a maturity. That's really important. Your marketing budget, you could say I'm going to spend $20 on, Instagram or Facebook or whatever. But I'm looking for more than that, right? So if you show historical context as far as, oh, I've successfully run this campaign, it got me this much, my customer acquisition cost was this, and therefore my marketing budget is going to be that. It's a much more sophisticated explanation of the marketing budget. So the competition, we talked a bit about what that should look like. It's super important to show that, hey, the world that you're existing in, you're ready to adjust. You'll know what your competition's doing. You won't get blindsided. Market size reports. So here's my advice. If you have any market size reports, and it's a 100-page document, I'm not going to read a 100-page document, but would be impressive, out of that 100-page document that you've used Adobe PDF, highlight the sections that you find important. And if you write a cover letter that says, this market size report, pages 11, 12, 15, and 75, highlight the assumptions that we've used in our financial model. Then I see, okay, now you're helping me do due diligence. And when you do that, I can make my decision much, much, much faster. Suppliers, I've been thinking lately whether or not I'm going to take that out. During COVID, people who had very good supplier contracts had a huge competitive advantage over people who didn't. If you're able to procure something at a cost that's, if I see in your financial model that you're telling me widgets are, $2 and on the market, they're usually $6. This could be a competitive advantage, but I'm not really going to believe you unless then I see a supplier contract that says, hey, I've locked them into that price for the next 5 years. Great. Now you have a competitive advantage. That would be great. So the only time really you want to look at key supplier contracts is I will ask for them if it's something really important. If you're a hardware maker, and you need certain items. Again, I worked with a startup recently. When we started looking into the supplier contracts, it turns out that they had only had rights for a certain number, a certain unit number. And after that, that supplier wasn't going to be able to supply them anymore. So I was like, okay, how are you what's the next step then? So that's why supplier contracts may be asked for if it's just such a key part to you executing on the business plan. And then invoices, again, you have to decide, with your instinct, why do I ask them? Because in the financial model, in your costings is everything. It's going to be the thing that provides your margins. So if I look at invoices, that say, okay, you've actually gotten the costings down. These are the actual costs. Again, at this stage, should you provide it? Yes or no? I think if you go for a 2 million raise, it's reasonable to get asked for. If you're asking for 100,000, I mean, if you write the cost down, you have to decide, if it's worth the time for you, yes or no. When you do a checklist like this, and when you create a data room like this, you can tell that by the end of this, you will know your business. If you go through all of this, you are going to know your business inside and out. You're going to be so ready to have absolutely any conversation with any investor. And that's my goal with this. Okay. So now we're at term sheets. And I want to thank, I see that 74 people are still here. Thank you for hanging on. Please download the link that was sent because I'll only leave it open during this seminar. So what's the significance of a term sheet? It's not legally binding, but it is pretty ethically binding. If I sign a term sheet, basically what I'm saying is, I like you. I'm willing to invest at this. I want to do post-term sheet due diligence. And should I look under the carpet and in the closets and everything is exactly as you said it has, we're going to sign based on this. And so it agrees high level to investment terms, valuations, voting preferences, things like this. Now, in the link that I gave you, there is a South African template term sheet. It's all open source, but it will save you from looking around. And there's other term sheets. There's a sample term sheet from EBAN, which is the European, actually Business Angel Network. But they're in partnership with the African Business Angel Network. So a lot of the templates are very much the same. So it'll still be relevant to you because I think most people attending this are from the continent. So I won't go through the entire term sheet. Okay. Just want to go through some of the clauses. This is kind of what it looks like. What's the name of your company? Who are the founders? Who are the investors? We talked about a lead investor. The structure of the financing. So what are you investing in? The pre-money valuation. And again, a lot of investors will ask for ESOP, means employee share option plan. 10% of total shares is it's a good healthy amount. And the lead investor, what role that they're going to take. And here you see a reference to, capitalization table. I'm going to give you examples. We'll get into that. It's basically who owns what. Okay. And then here, the reason that I copied this was conditions to close. I like this in this sample term sheet. So it's important for you to know. Now I provided you the term sheet. Under which conditions are we going to execute this? Okay, and so it's a good clause to have, and it's in your template that's in the folder. So I'm going to go into some of the terms in the term sheet and what their relevance is, right? So other rights and matters. Here we get into the anti-dilution right. So somebody had asked, what happens if things start not going very well? I'm going to get into an exact example of an anti-dilution, and what that looks like. Okay. And here, and it's not uncommon that we ask for the company to pay for the legal fees, and it should be capped. Okay. And the reason that we do that, we don't have a lot of management fees. We're really operating on a shoestring budget. So we understand exactly, as startups, that you are as well. The board. Here's where you get into voting rights. Okay. And this is why the board of directors, we've watched lots of movies. We've seen how board meetings matter. Here you will look at the post investment, what the board makeup is. You should have the majority for startup. After that, they will look at, again, we'll get into some voting rights here. If you get a good investor, you're going to want them on the board. They're going to actually be working for you. So it should not be a situation where it's policing. Your quarterly board meeting shouldn't be, when we got the 60 million investment, it was absolutely policing. They put in a ton of money and they absolutely know what's going on. In startup, we're working together. We're building something. That's why I love this phase. As much as 60 million was exciting, it wasn't as exciting, to me as startups, and building something together and creating something that nobody else has ever seen before. So you may ask for vesting. Vesting, if you're not familiar with the term, means that you have a right to a certain number of shares, let's say 20,000 shares. You have a right to those, and you will actually earn those over time. You will vest. 4 years is sort of common with monthly vesting. So after every month, you get a certain percentage. With a 1 year cliff, meaning that if you stop before a year, that you don't vest anything. Now, why? If you're the founder, why would you be asked to vest? That seems so incredibly unfair. And this can be negotiated. You can negotiate this to 2 years or whatever. Usually at startups, if I'm investing, okay, the product, but who's going to execute? 90% of what I invest in is the founder's mindset, their tenacity, their hustle. So if you're gone, the company is pretty gone. And so this is a way to keep you there. No shopping. Don't let this be more than 30 days. 30 days should be plenty of time. And you can even not sign this. Basically what it is, hey, when you and I get to the point of the term sheet, I don't want to have 4 or 5 or 6 other players at the table. That's advantageous to me. If you go into a term sheet and you have other VCs that are very close to wanting to get to your term sheet or sound very excited, don't agree to this at all. Just say, well, I have other people. Let's hurry up and get it done. Voting rights. So even if I'm the minority shareholder, there's certain things that I would like to talk about that I would like to have a right to have an influence on. So a change in the authorized number of shares. It's reasonable and unreasonable. Why do I say that? Imagine I invest in a certain amount. You and I agree to a business plan. If you're telling me ahead of time that in 2 years your cash is going to run out and you're going to have to do another raise, be sure and get that in the shareholders agreement. Get that into the business agreement that you're going to sign. Because you shouldn't be blocked in future raisings. And I have seen this happen in Greece quite a bit with startups, where the next round is kind of impeded by the first VC who came to the table. But you can understand on the VC side that if you raise the number of shares, my percentage ownership is going to be diluted. So, excuse me, it shouldn't come as a surprise. If it doesn't come as a surprise to me, and I know it's coming, it shouldn't be a discussion. But if all of a sudden you come and you say, hey, I want to raise 2 million more shares, you're going to be diluted to half of what you are. You can understand it has a huge financial implication, and therefore I'd want some influence in that. So that's the reasonable unreasonableness of that. Create securities senior or pari passu to existing preferred stock. What does that mean? I want to agree that if someone in the waterfall of payments, meaning when cash comes in, how it gets paid out, if someone is going to have rights before me, I want to agree to it. Now, for example, a bank loan will have senior security rights because bank loans get paid off before investors get paid off. Again, if we've agreed to it, if you're managing a relationship with your investor very well, it shouldn't come as a surprise and it shouldn't be an issue. And you have governance rights then that says, hey, we've signed to this and therefore you have to agree to this. And that's why governance is a big thing in the shareholders agreement you're going to sign. Declare or pay any dividends. Again, in the term sheet, you're going to agree to certain things. In your shareholders agreement, you can do baseline agreements as to under what conditions you would pay a dividend. So example, you have free cash flow. As a VC, I could say that I don't want dividends paid in the first 2 or 3 years because I want all the cash coming back. But then again, if you're a founder and you've worked hard for 5 years, so you start seeing some of your cash, it's not really good business on my part if you become unmotivated. So these things are the things that you agree to. But you can understand how if there's cash in the company as a minority shareholder, I'd want to look at how it's spent, especially if you say, hey, in 24 months, I want to go raise more money. Well, then why did we pay out cash dividends? Why didn't we just invest in the company and us not get diluted? So that's kind of why that's reasonable. A change in the authorized number of directors. This is, of course, about power. If you're going to put 2 more people on the seat on the board, this is going to change voting rights. This is going to change that kind of dynamic. So it's reasonable that I have a right as a minority shareholder to have input to that. Liquidate or dissolve. Often liquidation, people think about that as bankruptcy. Liquidation just means that if you do a company sale or buyout, that's a liquidation event. It's a liquidation. It's a change of the shares, basically. And I'm going to want to know, I'm going to want to have buy-in to some of that. How you do this, the shareholders agreement, we're going to get into it later, about why it's important to really have a handle on the agreement and how this would look like. Okay. So anti-dilution clauses. This goes back to the question that was asked before. What happens when things go wrong? Anti-dilution clauses come in when the next round of investment is a down round. Down round meaning that if I paid $1 per share, the valuation is such that even we're raising more money, it's 80 cents per share. That's a down round. I don't want to be penalized because I took a risk on you early. We agreed to the business plan. Life happens. Things aren't going as well as we thought. So I'd like some kind of protection. Now, what's reasonable is that you should have the formula that they're going to use for the anti-dilution. There's 3 terms: broad-based, narrow-based, and fully ratcheted. We're going to get into exactly what those are. Don't worry. But the formula that's going to be used, the math formula for the calculations of these, should absolutely be in the shareholders agreement that you signed. Okay. Now I have a sample. This is sort of the most commonly used one, and I'm going to go through the math on it so that it doesn't seem intimidating to you when you come across it. I'm sure a lot of people are good at math, but this is really completely algebra. So here's the formula. I know this looks like a lot, but I color coordinate math examples after this. So don't worry too much. So conversion price 2. So after the calculation is equal to the first conversion price. So the $1 that I bought in at times A plus B. It's the number of ordinary shares outstanding, right? So the original one. We're going to go through this exact formula with an example. Okay. Divided by A plus C. This is the most commonly used anti-dilution clause. Okay. So let's get into an example, an exact example. Okay. The company raises 5 million Series A financing at a conversion price of 1. Let's pretend I'm the first investor, right? So I paid $1 in. Basically it's a 5 million investment, so I get 5 million shares. The ordinary shares before were 20 million owned by the company. So that gives 80% ownership to the original, let's call it the founders. And I have now, I have 5 million over the 25 million. So I have 20%. So it's not, I'm not buying shares from the 20 million. It's not 5 over 20. We're creating new shares. So I have 5 over the 25 million. So that's how that works. Right? So let's say we go to the next financing round. The growth wasn't as fast as we thought. Now it's going to be 80 cents a share. So now without an anti-dilution clause, what basically happens is that I have now 5 million shares over 35 million in total. So I've been diluted from my 20% down to 14.29%. Okay, that's what happens if there's no anti-dilution clauses. And the new shareholders have the 10 million over 35 million, so they have 28.5% of the company. Now, what happens if we use a broad-based anti-dilution? So I used colors to make it easier. This is how I basically taught myself this stuff when I was in my first days in venture capital and looking at these. I used color coordination to make the math easier. So the original conversion price was $1, right? In broad-based, the difference between broad and narrow-based is going to be this definition of A. In broad-based, basically, you're including all previous outstanding shares. That's the value of A. You'll see in narrow-based, it's just my share. So the 5 million. So this is the difference, is the value of A. What shares do we look that create the value of A? Plus B, which is the new, total number of shares divided by C, the investment divided by T, the total common shares. So this is the formula. Okay. This is how it works out. And basically, instead of the $1 per share that I paid, now it gets bumped into up to 94 cents. And then I rebuy the shares at that new price. And I go then from 5 million shares to 5.3 million shares. And so I don't get diluted as much. Okay. It's fair, right? I took a risk on you early on. And so, I shouldn't be penalized in the next round if things didn't work out so well. What the difference is between narrow and, broad-based, again, conversion price 1 is the same, is the value of A. It's now 5 million instead of the 25 million. This gives me, C remains the same, B and C remain the same. And essentially then the difference in that changes my conversion price then to 86 cents. So now I have 5.7 million instead of 5.3 million. What does that matter to you? Well, you see in the ownership side, and I have a summary table after this, is that you're going to lose more of the company. Now it's up to you how you're going to negotiate, if it's broad-based or narrow-based. Basically, if you have a down round, you really want your initial investors still on board, still invested in you, doing well and wanting to do well. So it's up to you, how you want to divide the value of A. But I wanted to give, an example. Now, fully ratcheted means, hey, I'm not going to be penalized at all. I get the 80 cents as well. And that means then that I get 6.25 million instead of just being stuck at the 5 million. So it's up to you to negotiate with them whether or not the anti-dilution clause is going to be, broad, narrow, or fully ratchet. Okay. And the difference to you, it's down here, is for me as an investor, it bumps me up by 2.95%. You end up losing 1.97%. What does this mean to the new investor? it also impacts them as well, but you'll see it impacts them very little. So the broad-based impacts them very little. And they should be willing. They want the old investors also not to create difficulties at the board of director level. So they'll probably agree to this. Liquidation preference. I really, really, really want you to understand this. Okay. This is where founders get really hurt. So I see we still have 73 people. Thank you for hanging on. I want you to, I don't know, shake your legs, take a drink of coffee. I don't know what, but this is really important. So liquidation preference defines who gets paid first and how much they get paid. Okay. Not that you have two terms for liquidation preference, non-participating and participating. So non-participating means that as an investor, I choose between the multiple or the shares. And the participating liquidation means that I get both. So I'm going to go through an exact math example. Okay. Let's say Series A shareholder invested 20 million for 50% and the company sells in year 3 for 60 million. That's not bad, right? 60 million sounds good. In year 3, it's really soon. We've done really well. Now, based on the liquidation preference, now the math on this is going to shock you. I've done that on purpose because I really want you to be careful around this. Okay. I'm an entrepreneur at heart at first. So there's no point in my mind why VCs penalize, startups. So the worst case scenario is a participating liquidation of 2x. What does that mean? That means I get 2 times my investment amount first. 40 million of the 60 million. Okay. That's what 2x means. So we take 60 minus 40. That means 20 million is remaining to divide between us. And I own 50%. So that means that I get 50% of the remaining amount of 20 million. That's another 10 million, meaning I get a total of 50 million as the investor who signed you to this participating liquidation of 2x from the 60 million, and you only get 10 million. So this liquidation preference is often misunderstood by entrepreneurs. And if you're shocked, you're going to be even more shocked when we do the next math. So non-participating looks a little bit better. As a VC, you have to decide, do I want to take the 2x or do I want to take the 50%? So in this example, the 2x is higher. It's 40 million from the 60. So that's what I'm going to take, right? So the founders, you get 20 million. It's better, but it's not like you probably thought. You would think, okay, at 50% of 60 million, I get 30 million. Not with these types of clauses, right? So your goal is to get a liquidation preference of 1x or none. Now, why do VCs do this? It's to try to protect on the downside. Let's say things are going bad and the company gets sold. They want to at least cover the amount of money that was invested. What do I use liquidation preference? Usually I do 1x. I do, but to be honest, I've never carried it out. When the company goes bad, if the entrepreneurs, what this does is legally give me that right. But doesn't mean that I have to necessarily execute on that. It depends though on the VC's relationship with their own shareholders. So I at EcoSeeds, we endeavor to do the best for startups. However, you can have as a VC, you can have a fiduciary responsibility, meaning if this is signed, they have to execute on it. Now, let me get into another example, dividends. A dividend, you know what it is. It's a fixed value or percentage of the share's original price to be paid periodically to shareholders, right? There are 2 types of dividends. There's non-cumulative dividends. They don't accrue on the balance sheet, and there's cumulative dividends. And the difference is very important. So the goal would be 6% non-cumulative dividends annually with board approval. That's the clause, your goal. Let's give a sample scenario, right? So let's go back in to the previous example and say, okay, we have 6% cumulative dividends, 2x participating. We have the 20 million for 50%, and we have a sale in year 3 for 60 million. So if it's cumulative dividends, meaning that you didn't pay it out at the end of the year and it's sitting on the balance sheet kind of like an accrued loan, that means that the 6% of at the 3 years is 3.6 million because it's 6% on what I've invested. So it's 3.6 million liability that has to get paid. Now, again, the shareholders agreement's important in the language. Whether it gets paid first before the waterfall of payments. Waterfall payments, again, as a reminder, is how money is paid out afterwards, or if it's going to be paid second. So let's go through the math. We have the sales price of 60 million. It gets paid first, 3.6 million. That leaves the 56.4 million left. Now, in my 2x participating, remember, I get 40 million. That puts us down to 16.4 million. Plus 15% of the remaining 16.4 million means that I get a total of 51.8 million out of that 60 million. Okay, this is why I put this in every single one of my investor readiness presentations, because this is a nightmare scenario. And all it is about whether it's cumulative, non-cumulative, and participating or non-participating liquidation. These terms you have to know. Okay, I've had so many entrepreneurs cry on my shoulder. They come to me afterwards when it's too late. And it's, once this is signed, it's almost impossible to negotiate out of it. So the 3.6 million, if it's paid after everything, it looks even worse. So, you take out the 40 million, which is the 2x, then you divide things 50%, and then and then you take the 3.6 million out of what's remaining. I actually get 53.6 million, and you end up with only 6 million. So I'm going to pause right now and ask for questions, because I really want you to understand this. This is super important.
Sure. Thank you for that, Serena. I'm sitting here and absolutely mind blown by these calculations. And I'm thinking that even though when you start a business, you're not thinking liquidation at that point, but it's so important to take these steps into consideration and understand what it means for your business when going into a marriage or a relationship or a partnership with a VC. Okay, I'm going to head over to our questions. I'm going to start with one question that I did spot earlier that speaks about dividends. It's from Bertram. Hi, Bertram. And he wants to accommodate staff shareholding in future. What should the new staff shareholders expect if it happens after a VC has funded the business? That's part A of the question. And then part B of his question is, should this intent be declared to the VC at the start, or does the DD start again?
So this is, if the VC asks, of course, share, but this comes out in the term sheet. What's the intention around dividends? Could you repeat the first part of the question? I'm not sure I understood it.
The first part is, what should the new staff shareholders expect if it happens after a VC has funded the business?
So this is just the shareholders agreement where, 6% dividends, any investor will say, okay, I want dividends. Of course, obviously. And just to remind again, a liquidation event is not about bankruptcy, right? We show here that it's sale year 3. So it's about anything, your mutual goal is to sell this thing or to get a buyout of some type, maybe a larger shareholder. Dividends are just agreed to in a term sheet and in a shareholders agreement. 6 to 8%. Again, you can use that as a motivating factor if you're having a hard time raising, but again, don't make them cumulative.
Okay. Bertram, I hope that does answer your question. If you would like a follow-up to that, you are more than welcome to pop it into the Q&A box and we will address it. I do want us to go back to a previous question. I think it was from Ntabise. Yeah, she wanted to know about potential failures in the future and then we had just noted it to respond to it at a later stage. She wanted to know what is the typical recourse or next steps if a portfolio company doesn't meet performance milestones or even faces potential failure.
So potential, and that the sense of potential failure, this liquidation comes into play, right? So, you're going to try to raise the next round to keep the company going. It'll be a down round, so that anti-dilution clauses is one thing that the company will use. If you really feel like it's just a complete failure and you're going to shut down, basically then a VC can sell off the assets to try to recoup based on its liquidation preference. That's one of the things. Now, what I have done in the past is if it's not uncommon that a CEO is really good at raising a company 0 to 1 million. We look at succession planning. Often a company will outgrow a CEO's skills. That's something different. Once you're growing, it becomes often operations, and a lot of entrepreneurs are sort of the visionaries, right? So you can move into a role of strategy or something like this without having to leave and hire in a CEO to do that operations or to hire in an operations person. And so I'd sit down with the entrepreneur and talk to them and say, hey, let's do succession planning, or, this is failing. Either we're going to jointly go try to raise some more money. We're going to look at selling off the assets in order to recoup some of the fees. If it's really going bad, then, again, if you're really an entrepreneur, I've never known an entrepreneur who hasn't started company 2, 3, 4. If you want to maintain a good relationship with the VC, let them do the asset sale. If you feel like, no, this is it, never mind, I'm going to go work for somebody, I guess you could fight a little bit harder. But at that point, if you've been drawing a salary, I think for long-term relationships, it's good to allow them to take on the liquidation to sell off those assets if everything's really, really goes bust. In the question about not reaching your milestones, again, if you're 2 or 3 years old, we go back to the checklist. If you have been mapping out your milestones, and this is something to do for yourself, that checklist is really useful just for yourself and how to run the business yourself. Are you good at predicting and managing resources to achieve those milestones? If you're struggling with that, personally, Zad and I, we want to be partners. We don't want to be police. If you're struggling with something, then maybe it's time to hire in somebody who's better at those things and for you to find the place. Maybe you're a great product manager or a visionary, or you're good at the sales or something like that. Or maybe you just want to move over to just being a shareholder. That kind of discussion can be had together. There are VCs who will say, okay, if you're not meeting your milestones, I get more and more of the shares because things are going bad. To me, 100% of 0 is 0. So it has to make sense. It should be kind of a thing. So if you have a VC who just says, hey, you're not meeting your milestones, I get more and more shares, I would ask them to provide value with that. You get more shares for the sake of what? If you're struggling and the company's not doing well, they should help you either recruit somebody to do it better. You should be growing together. They should have people and access to people that can help with skills, but it should be mutually agreed to. I was working with a company recently in Greece, and the shareholder wanted to hire somebody in. It was an agricultural play, and they wanted to hire in a senior person from a large brand. But the argument was made then by the entrepreneur that said, hey, but we're not there. He's very good at large budgets and marketing with large budgets, and we're really small. This isn't the right fit. I agree with you. We're not doing well. We should bring somebody else in, but is this the guy? I hope that answered the question. I'd like to get confirmation from her that this answers her question.
And Sabi saying, if you can just let us know in the chat section if that does answer your question. What I'm really gathering from what you've shared now, Serena, that it really does boil down to the kind of relationship that you have built with your investors. Okay, I'm going to move us along. Anonymous has asked that many VCs in Africa look for startups with B2B models. Why is this the case?
So you will hear a lot in VC this thing called risk-adjusted returns, right? It sounds like a bunch of blah-de-blah to me, but B2B for them sounds less risky because you're selling to a business and they feel that businesses have more stable income and have larger budgets than households. What is the most expensive thing that you pay for as a private consumer in your home per month? Probably your internet connection or, well, obviously your mortgage, but beyond that, what's the highest thing that you pay for? If you're selling B2B, a business can afford a much higher expense for what? Software as a service. If you become vital to them running their business, they feel that you're helping them generate revenue. Whereas if you're selling to consumer, basically you're a cost. You can be improving their life, making their life happier, but you're not helping them usually generate revenue, right? So this is why B2B. Now, I love B2C. If you look at what are the biggest companies right now, if you look at Apple, you look at, Twitter, I apologize, I'm not using African examples. These are B2C. They're big, super huge, big plays. If you look at Apple, they've even managed to become a bank. People who use Apple Pay, essentially, they're holding on to your cash for even a short amount of time. They're becoming banks. So I think that it's short-sighted, but I understand why they do it. I think that once VCs feel much more, I think whatever VC is gonna be rewarded hugely for taking a risk on B2C and understanding just the huge, huge, huge potential of Africa on that.
Sure. I guess for the VC as well, it is also about risk management and maybe sticking to what they know best at the time. Obviously, this doesn't apply to all VCs, as like you've just mentioned. Others are investing in B2Cs. Okay. Shazia wants to know, how difficult is it to gain seed funding for the development of a mobile app with a development cost of $200,000? It takes 10 months to develop before the product can be launched.
So you're talking about wanting somebody to invest just from your brilliant idea. This is tough. This will come down to your CV. So, if you're a computer engineer, you've done something before, you have a track history, this is the third app you're going to launch, it would be easy. If this is the first one you're launching and your degree is in art history, it's going to be more difficult to launch unless this app is related maybe to art history somehow. So it's going to be a lot of, does your background and your own track record prove that you can execute on this? This is something that's really suited for angel investing, right? I think it's very difficult. It's difficult to say. I'd want to look at your CV. How far are you at? To just get money for an idea, it's tough. It's really tough. Usually you need some kind of mock-up, just some kind of mock-up, and getting people to say, hey, I really want this thing. And there are no code, we just, with the South African company, actually with the woman, she used a no code software and she coded it herself to get a, sort of a minimum viable product going and starting to get customers, even though it wasn't the end solution. So there has to be a way to get some sort of traction.
Traction first. That's what I'm gathering from you. Traction first. I think just off the back of that question, Amir wants to know how can we actually value a startup, and why do VCs prefer multiple revenue streams? How can we calculate the correct multiple revenues?
So for startups, valuation is really, really an art form. I think at the end of the day, people use valuation for startups because they want to know their starting position. So if you only want to give away at 6% and you're a first round investor, getting a first round in investment, and you're definitely going to raise future rounds, this is why they're pushing the valuation law. If you go in there and you just have an open conversation with them and say, hey, what equity position are you looking for? Let's not have this discussion about valuations that's really an art form. What equity position do you want to start with? I think this is what matters. And that kind of cuts through that whole discussion. I have tag along and drag along, but here, yeah. For the cap table scenarios, that's where that kind of work. Now, cap tables are so specialized. I have some examples, some basic math examples, but a lot of that is going to be because they're concerned about future dilution. This is what the real discussion is about, rather than valuation.
Rather the future. Apu had also asked a question around equity, and she wanted to know, how do we determine how much equity we should offer a VC on the investment?
So I think it's kind of a different way to ask the same question, right? So valuation basically says, what do I get for the 5 million? So in the example that we had done before, it was 5 million shares over the total 25 million. I think you have to do the cap table. And if you're going to raise money one time and raise break even, what's it worth to you? You have to understand how you're going to be motivated over time. Now, I'd love to say that this is the math example, that it's just straight up 6%, 10%, 15%. I would not give away more than 15%. If you're going to raise future rounds, if it's smart money, like Zad and I come in, we help do sales. We make ourselves, accountable employees in a way of how we're going to raise valuation in the future. Then we say, okay, 15%, and we get another 5% if we actually make our own sales targets, if we actually make our own milestones. So I think it's a partnership agreement. What are they offering you? Are they offering you only cash? Are you gonna need to go for another round in 24 months? Then you have to fight for a less equity position. But if you really have a good partner, you want to get this going. Again, if you start with 15% and you know that you can raise your valuation in a short amount of time hugely, then your next round, you're going to be diluted less. That cap table is such an important thing. I think I need to do a master class just on the cap table, but that discussion has to do with how the future looks. It's not an easy question to answer.
Yeah. But I think just to sum it up as well for her, 6% is a decent place to start, and look it up between 6, 15, and possibly even 20, depending on how the future looks. Okay.
And the value add of the VC.
And the value add of the VC. And the value add of the VC.
Absolutely.
Mahlodi had asked us a question. She starts off by saying, our mission at Bear Mind is to revolutionize mental wellness in Africa, and our unique blend of AI-driven personalization, blockchain-based rewards, and virtual reality experiences. What aspects of our approach do you believe would be particularly appealing to investors at this stage? We are in the finalization of launching our platform. Furthermore, are there specific challenges that we should proactively address to enhance our investor readiness?
So first of all, congratulations. It's a really important space to be in around mental health. I think that, in Southern Europe, and I know I've been doing projects in Africa since 1997. And in Southern Europe too, mental health just wasn't talked about. I remember one woman saying, don't you have friends to talk to? And it's like, well, yeah, okay, but they can only help so much. So, congratulations for picking a really good space. The checklist, the due diligence, investor readiness is really about being prepared for that due diligence. As far as, using, it's really good buzzwords right now, blockchain, AI, things like these. When you're talking about, human wellness, AI is basically data mining things that already exist, and each human individual, is just that, an individual. So we have experienced limitations of AI towards such an individualistic thing. It can become even dangerous when it comes to mental health because it's so very unique to each person. But I think it has more to do, it always comes down then to execution. Who's training your AI? Is it a doctor? Is it a specialist for mental health? Who's doing the training of AI, the AI itself? Where are you getting your data set? How is that built up? That's really important to the whole AI discussion, right? There is no such thing as artificial intelligence. It's machine learning. We like to call it AI, but it's not. It doesn't learn anything. It's basically data mining in a very sophisticated way. It's machine learning. So the cookie recipe for this is really who is feeding that data set? How are you looking at it? That's the most important thing in that scenario.
Okay. And then, Matlodi, I hope we've answered your question sufficiently. And if not, you're welcome to pop another question following that up. We also have a question from Lynn, and she would like to know, what advice can you give an SME regarding maintaining ownership of the company after handing over to a more skillful and prominent CEO to run the company without being bought out by the company?
So a CEO at that point, when you've hired a CEO because you're sort of outsourcing, it comes down to roles and responsibilities. And again, this governance structure. What decisions is the CEO allowed to be made in the sense of what size check can they sign? The product roadmap should be agreed to quarterly. So that means the expenditures that they do and things like this. If the CEO comes back and he trusted their experience, an example, the first startup that I worked for, iChat in the US, again, it was a really smart technical programming guy. And then the company I joined when it was a 20 million investment. And that CEO, he had already taken 3 companies, on the stock market. So at some point, when it's that big, he had to use his instinct and just defer to the CEO and say, hey, I trust you because you've done this before. So when you say lose control of the company, you're hiring a CEO, he has a management contract. You can make it yearly so that if he's not doing what you think, that you can basically fire him. You still own his, employee agreement. So that's how you maintain that control.
Yeah, at the end of the day, the business owner is still the business owner, even though there is a CEO running the company. So it goes back to the agreement that you had in the initial place. Okay, there's a comment from Roy in the question section, but I do think it's quite a helpful comment. He says valuation in Africa is based on EBITDA plus 14 or 16%. However, in other markets, there is potential. He then also pops in a question, and he wants to know, how does an African startup access markets that value better for projects back at home?
So the EBITDA multiple that he's talking about is only, you have to have X number of years of revenues before you have EBITDA. EBITDA is earnings before interest, tax, depreciation, and amortization. So there's no EBITDA without revenue. So in early stage, a lot of it, your EBITDA is going to be very low because you have such high expenses. So that's a tough one. I've seen more valuations done based on the monthly occurring revenue and then looking at how that would work towards discounted cash flow. The second part of his question was, how do we access So this is a good example. In Southern Europe, this is a good question. In Southern Europe, valuations are very low. In Northern Europe, they're much higher. They have faith in the ability to grow. They're not as punitive. I think the beauty of, I think you should actually absolutely go shopping for VCs. It's in their thesis. If they're willing to invest globally, usually there are very few VCs on the African continent who pick geographically. They'll pick like West Africa or North Africa or something like this, but it is getting more and more competitive, which is good news for startups, because that valuation discussion right now, I find that most startups are overpriced. But I also find that there isn't this sort of smart money. I think the angel investment, I probably shouldn't say this as a venture capitalist, but I think the angel networks are really good on the continent. They may be willing to give you a better valuation. In fact, if they represent smart money, so you will have people who can open up sales channels for you and things like this. Absolutely shop for VC. But right now, you've had, especially Nigeria, has really pushed valuations too high, just really too high. But early stage startup can't be based on EBITDA unless it has years of revenue. So try not to let a VC do that to you. You guys have to agree to this future vision of what you're going to do. So either discounted cash flow, again, that's tough. But your proof that you can create annual or monthly recurring revenue is going to be really important.
Okay. Prove that returning revenue. So, you did make an interesting comment that I'm going to ask you to elaborate on a little bit. You said that in your view, startups are overpriced. What do you mean they're overpriced?
So let's say, right now people want to give away 6% with NB pre-revenue and take 200,000. And it's like, how, that's a 15% at least, that's 15% right there. Now there's one, South African startup, she was presented this and she said, okay, so how do I get to the 6%? And those investors said, we love your idea, whatever, but 6% is crazy at the scaling. So they said, okay, we'll go back and start doing sales. Now, how do you make sales without the investment? That's a tough one, but she's decided that that's what she wants to do. So, good for her. She's rolling up her sleeves and losing sleep for sure. But I think she's gonna make it.
Okay. So it's possible. It's
okay. But it's tough. You have to give away more if you are pre-revenue. The risk is higher, right?
The risk is high.
That's fair. But I have noticed that Africans don't like giving away percentages. And I just think, again, 50%, what does that mean? I mean, if you never have to raise money again, that's not bad. What do you?
Yeah, I guess be fair in what you're willing to give for what you're asking for. And again, kind of invest as well. Yeah.
If you don't fall in love with the investor, no wonder you only want to give 6%.
Back to the relationship that you have with your investor. That does bring us to the end of our current questions. Guys, if you have any more questions, please feel free to keep them coming. We do have Serena with us here to answer your questions, but for now, Serena, that's all from questions perspective.
Okay. All right. Let me share screen again. We'll get through this. I really appreciate everybody who stayed on. So tag along, drag along lights are also common term sheet terms. In the event of an offer, preferred shareholders who carry this clause can secure tag along rights, which means that, let's say that you find a buyer for you want to sell 10% of your shares and get some liquidity. If I have a tag along clause, it means that I have the rights to be brought along with this offer that you have. I can tag along, but I don't have to. With drag along, for example, if I'm as a VC, we've talked about the life of the value. We're at year 9. If I find a buyer, and I have a drag along right, I can force you to sell. And so that's important to know the tag along, drag along, and to put other qualifiers into your shareholders agreement. So for a tag along, it's often important to set a minimum share, a minimum sales price. So for example, in the scenario we had before, if I'm in year 9 or 10 of the fund and I get an offer for 25 million, then, and especially with those liquidation preferences, I would want to sell. And with a drag along, I could force you to sell the company at 22.5 million. And I get out of it, you could end up with basically practically nothing. So you really need to sort of set a minimum sales amount, even when you have a drag along, tag along. Now, all these things are, for smaller amounts, when there's tons and tons and tons of money, everybody's happy, everything's going along. But realistically, you're going to, you have to also look at average scenarios and then worst case scenario. If you're an entrepreneur, if you're a serial entrepreneur, then you don't care if the thing has failed. You're just like, okay, I look at the long term. I'm going to start another company or another 2 companies. I want a good reputation in the VC world. Let's let them just have it. And I've seen in these scenarios, this exact one where the entrepreneur said, hey, I want to be able to come to you the next 12 months with my next idea. And the VC was just like, absolutely, because sometimes things don't work out. So this is the importance of tag along and drag along rights. I'd rather have tag along is kind of better. Why would I want to drag along? If I can force you to sell, oftentimes buyers, they don't want old management in place, especially if it's an industry sale. They have their own ways of doing things, their own company culture and things like this, and they just want the old ones out, and they're probably just acquiring you for your database, basically. So what happens after post-term sheet? The VC often goes to the premise and interviews key staff. My first job in VC was on-site due diligence, and basically I had a laptop and I stayed on the premise for a week. And you just get a feeling then if people, how they get along, what kind of team it is, and things like this. A code review, if you're a software, you have to be careful about the recipe, right? There are ways to ethically carry out. Usually it's by a third party, and they will look at your code. There have been cases in the past where the code isn't documented well. It's not ready for scalability, and that really then lowers the value. Even if the product is running well and you have good customers, but if the code is just designed in a way that it can't scale, that really impedes your valuation. Have your subscription agreement ready and your shareholders agreement ready. I believe there are, I didn't include in the list of items, examples of these, because these are very, very, very legal, but you can find some templates online. ChatGPT, see how it feels, but this is the time to engage a lawyer. Absolutely. The internal preparation of the company, make sure that your team is aligned with main messages. At the point that you're going to have a VC and you're doing on-site due diligence, if your staff doesn't even know that there's investors or something like that, you don't look really close and organized. They need to be aware of milestones to be achieved with the investment. So if I go and I talk to a programmer and he doesn't even know what the milestones are, or where the product roadmap is, that doesn't look good. The staff should know KPIs, key performance indicators, the main ones. Whatever you've communicated to me as a VC, I want to see that you are a good leader, that you have your internal team. Absolutely everybody is aligned, that they understand what your goals are, that the financial model, cash flow, use of funds, org chart. Yeah, we've gone through all of that. Just make sure that your finance person knows, that each part of the organization is aware of their part of all of this due diligence, that they're saying the same thing that you're saying to your VC. And I think we've come to the end.
Wow, sure. Thank you so much for that, Serena. Just going to check our questions. Okay, we've answered everything. Just a reminder, we do have a prize for the attendee who has stayed on for the duration of the webinar and actually completes the survey. Serena, I do want to thank you in the meantime. I've also seen some great comments in the chat section from our attendees. We've also received confirmations that our questions have been answered sufficiently. So thank you very much for that. I know that Apua also said loving these questions, which really goes to show that your engagement, everybody, has been absolutely worth it. So thank you very much for that. I am going to give our attendees some time to ask any more questions that they might have. I'm going to give them a minute or two before we close it up. So please, guys, if you have any other questions, please do pop them in the Q&A box. Now is your time.
And feel free to reach out to me on LinkedIn. Let's connect. And I know Innovator Trust will have other seminars. Maybe we'll do one just on cap tables because it's such a big deal. But also hand each other your LinkedIns, and please, please, please download the data room.
Yes. So all the stuff on the Google Drive that we share with you guys, once again, is only available for the duration of this webinar. It will be closed once we are done here. So you're more than welcome to download all the tools that are up, that have been uploaded by Serena. So please do that before you forget. Also, please do not forget, once we end the webinar, there will be a prompt for you to complete a survey. That survey will also help us get a sense of what other topics would you like us to cover under the Conversations to Innovate banner. I see we do have some questions from Anonymous. Are you going to share the recording? Yes, we will be sharing the recording on our YouTube channel. So please do find us on YouTube, hit follow, and you will find the recording there. Says that I've learned so much today. Thank you so, so much. Thanks for all the answers to all the questions. Very informative. I think that then wraps us up. Oh, there's a question from Mahmoud. Where can I download the recording? Mahmoud, you'll find it on our YouTube channel. I think I'll just put, it's at Innovator Trust on YouTube as well. You will find the recording there once we are done, and it's packaged quite nicely. If there's nothing else from anybody, that does then bring us to the end of today's webinar. Serena, you have been absolutely amazing and insightful as per usual. We thank you so much for your time. I know you were up not even since 3 a.m. You started this webinar at 3 a.m. So I can't even imagine what time you got up to make sure that you're here on time and delivering at your very best. So we sincerely appreciate you and all the insights that you have shared with us. And that is it. To everybody else that joined for today's session, thank you very much. A big thank you from myself, a big thank you from the Innovator Trust. Be sure to follow us on all our social media platforms and be on the lookout for the recording. I do think we've lost Serena, but it's okay because she has given us the absolute best and has completed the presentation already. So thank you so much, everybody.